Hi, my name is David Pereira, and I'm the founder of Rent to Grow Homes. In today's video, I'm going to cover the non-resident speculation tax, which is a tax that is applicable to new Canadians still awaiting their PR status. What we've learned is that rent to own could be a very viable alternative. So let's get into some of these details. So in this video, I'm hoping to teach you four things. Number one, what is the NRST? Number two, what is rent to own? Number three, we'll explore whether rent to own might be a good fit for you and your family. And number four, I'll go through an example of a client we worked with for our rent to own program and show you the numbers for their particular case. So let's go into a little more detail about the NRST, the non-resident speculation tax. So this was a government policy introduced in 2021. And the reason it was introduced was really to prevent speculative condo buying. So prices of homes were escalating in Canada, in Ontario, especially condos in Toronto, but all over Ontario. So one of the policies the government brought and enacted was the NRST. And unfortunately, like with many government policies, there are unintended consequences. And one of those consequences for this was that it really hurt new Canadians awaiting their PR status. They're going by the book, they're going through the proper channels and trying to get the right approvals. They're trying to get a house and they've got good jobs. The banks approve them. But if they were to buy the house without PR status, they would have to pay an additional 25% tax on the purchase of the home, and that would be due upon closing. So let's go through an example here. Let's assume you're an immigrant family, you don't quite have your PR status, you've applied, you're expecting it within the next 24 months. The banks approved you for a budget of $400,000. Let's assume you work with your realtor, you find a home that you love, it's a closing November 1st. Upon closing, or just before closing, you're required to pay your usual 20% down payment to the bank, but also the NRST tax of 25%, which in this case, a home worth $400,000, that would be $100,000. You will get that money back, or you're supposed to get that money back, at least a portion of it back, once you get your status. This is what it says on government websites. But for some reason, they don't guarantee it. They often say may receive all or a portion. If you want to get more information about the NRST, I invite you to check these two pages. So number one, if you go to ontario.ca and Google non-resident speculation tax, you're going to find the official details here. It goes on, it goes and explains sort of all the stuff, who pays it, exemptions, the rebate refund. If we go to that, it says may be available. So again, you should be getting all of it back, but for some reason they're not saying that. I also have a blog on the Rent to Grow Homes website that goes into some detail about how the NRST is applied and other important things. I'm going to link both of these links in the YouTube notes, so you can get those links there. So in that example, we said that a family would have to pay an extra $100,000. If you're like most newcomers to Canada, you don't have an extra $100,000 sitting in your bank account or hiding under the bed. So how do you buy a home? Well, what we've discovered is that rent to own could be an alternative to the NRST. So let's quickly go through this process. With rent to own, the first thing we do is qualify you. We look at your financials, we look at your pay stubs, we basically do a proper sort of financial analysis, and I talk to you, and assuming you're a good fit, we qualify you and give you a budget. You then work with your realtor, choose the home you want to live in. Let's assume we're doing a 2-year contract because you expect to get your PR status within 2 years. Well, then you would rent the home for those 2 years. You'd be paying kind of slightly below market rent and an additional amount. And that additional amount is how you earn your home. We've agreed on your future purchase price. It's typically 10% more than we've paid for you. But over those 2 years, you're going to build your savings with that additional savings amount. You're also going to raise your credit score. Now, during these 2 years, we expect your PR status will be approved. And once that happens and the contract is finished, you will then own your home because you're buying the home back from us at the predetermined price. So those are the simple steps on how rent to own works. And the nice thing is this is totally legal. It helps you avoid that NRST. It gives you the home you're looking for. And so it's really kind of a nice win-win. And it's an alternative to paying the 25% tax. So let's go into some details about what is rent to own. So rent to own is a program that involves tenant buyers, rent to own investors, and then operators, and that's my role. A tenant buyer is someone who wants to own a home, but they can't get approval from the bank today, or they have to pay the NRST because they don't have their status. We call them tenant buyers because in the short term, they're going to be tenants, but longer term, they're going to be buyers of the home. The rent-to-own investors are not large institutions or large businesses. These are normal people who simply have some savings, or they have a home line of credit, and they want to put that money towards good use. And they think that helping someone earn home ownership is a good use of their money. And lastly, there's the operator, which is me. And my job is to make sure everything works. I sort of sit in the middle. I do all the communications. I make sure everyone's getting the money they're supposed to get. I communicate everything. Basically, my job is to make sure that the deal moves very smooth. So let's examine whether rent-to-own is a good fit for you and vice versa. So number one, you're looking to own a home between $300,000 and $800,000. You make at least your pre-tax income, your gross income for the household is at least $90,000. Now, if you're making around $90,000, the best you're probably going to do is around $300,000, maybe $350,000. If you want a more expensive home, obviously you need to have higher income. You've got no criminal history, no consumer protection or bankruptcy. You've got at least $10,000 in savings that you would use for a down payment on day one. Each month, you're going to be paying slightly below market rent, but you're also paying an additional amount called an option credit. And this option credit fully goes towards your future down payment. And the last thing is you're committed to staying in this house for at least 5 years. This is not meant to be temporary housing. This is meant to be you living in a home with you and your family that you're going to love, you want to enjoy. So you're committed to this house for at least a period of time. Let's talk about the profile of a tenant buyer. So here are the typical tenant buyers that I work with who kind of fall into this NRST program. So number one, they're waiting for their PR status approval. They have good employment income. They want stability for their family today. What they don't want to be doing is dealing with landlords who might be selling. And this is happening a lot in Ontario. Rather than having to deal with moving every year until they get their status, they want stability. They want consistent rent. They don't want to have to be living under the stress of having to move. But they also need time. They need time to improve their down payment, so they need to save more. They need time to improve their credit score, and they need time to obtain their PR status. And that's why rent-to-own is a really good fit. Rent-to-own gives people that bridge of time that they need to improve all those things. The best part I like about rent-to-own is the people I work with, they're motivated to succeed. These are not your average renters that are just looking for a place to stay. These are people who want a home, and they're willing to work hard and earn home ownership. It's a huge reason I love rent-to-own. So let's go through an example with some numbers here. So Miguel and Sonia are in their early 40s, and they have 3 children. They moved to Canada a year ago. They want to have a home of their own, and they expect to get their PR approval within 2 years. They are living in Cornwall, Ontario, and they are going to work with their realtor. Today, they have $15,000 saved up for a down payment, and they know comfortably that they could afford $400,000 based on their incomes. But they're not able to get financing from the bank because of their credit score, and they don't have quite enough saved for a down payment. They also don't have an extra $100,000 for the NRST. So let's summarize them. They want to buy a home in Cornwall. Maximum offer price is $400,000. They're both working. Their annual household income is $120,000. Their credit scores are low 600s. They expect their PR status within 2 years. So over here, you see some numbers. Like I mentioned, the house today, their budget is 400,000. We're agreeing that they're going to buy the home back in 2 years at 441,050. How I got this number is it's assuming the market will go up 5% per year, compounded. So basically, this is 5% and then 5% again, and we get this number here. They're starting with $15,000, and I'm going to show you in the next slide how we get their savings up to $29,000. So here are the numbers. So we're starting with a home price today of $400,000. I explained that the house price in 2 years is going to be $441,000. So the amount of money they're going to need in 2 years is 5% of $441,000, which is $22,000. Then they have to also pay land transfer tax. They have to pay legal costs. So their target total savings in 2 years' time is over $29,000. Now, on day one, they're starting with $15,000. Each month, they're going to pay monthly rent, and the rent for a $400,000 home is anywhere between $2,300 and $2,700. I'm going to set the rent at $2,400 in this example, and their option credit is going to be $630 a month. This is an additional amount that they pay, and all of this goes towards their future down payment. So after 2 years, they have that original $15,000 they paid up front, and then accumulated option credits. This is basically 24 months multiplied by 630. And that gives us 14,920. So if we add these two numbers up, their actual savings in 2 years is $29,920, which is slightly more than this. So our goal as a company, as Rent to Grow Homes, is to help you increase your down payment, your credit score, so the banks have to say yes to you when you go for your mortgage in 2 years. So let's do a bit of a comparison from today and 2 years from now. So today, they're on a work visa, but in 2 years, they're going to be permanent residents. The home price actual today is $400,000. In the future, they're going to buy it for $441,000. The market price is $400,000 today. Who knows what the market price is going to be? But the price they're buying it at is $441,000. Their down payment today is $15,000. In the future, it's going to be over $29,000, which means now today they've got 3.75% of their home price. In the future, they're going to have 6.8% of their home price saved up. Today, they're paying rent. They're going to pay the option credit. Obviously, that goes away in the future because now they're going to be qualified for a mortgage and they'll be paying a monthly mortgage instead. In terms of who owns the home in those 2 years, it would be the investor, but then that gets transferred to the tenant buyer at the end of 2 years. The nice thing is that the tenant buyer lives in their home for the full 2 years, and then in the future, the investor is responsible for property tax, home insurance, paying the mortgage. In the future, tenant buyer takes care of that. And the tenant buyer is responsible for utilities, appliances, lawn, snow maintenance, just general home maintenance, both today and in the future. So this is a comparison of what the world is like today and what it's going to be like in 2 years when they buy the home. Now let's talk about some risks here. So let's assume the tenant buyer cannot qualify for the mortgage at the end of 2 years. So we did a contract with you, but you've not been able to get the mortgage when the contract's finished. So it really depends on why. If you've done everything you're supposed to do, you've saved, you've communicated well, you took good care of the home, we'll work with you and we'll find a way to help you. We'll extend the term for a year, or we'll look for some private financing. We'll look for some alternative to help you get your home. But if the reason you can't get your home at the end of 2 years is because you did not do your proper savings, you didn't follow the plan, well then that's your fault. And your risk is that you'd be forfeiting up to 90% of the initial option credit as well as those monthly option credits. The reason we do this is because this is a serious business and the banks are no different, right? If you didn't pay the bank your mortgage, you would lose your home. In this particular case, if you don't pay and don't finish your commitment to getting the mortgage at the end of 2 years, then you lose the savings you put into it. This is really to kind of be a deterrent and to make sure people stay on the program. If you stop paying rent, well then there's some serious consequences there. Everything kind of I mentioned before is true. Plus, we have to get the landlord-tenant board engaged. I've never had to do this. I never want to do it. But of course, I need to tell you that this is a risk. Illicit activity. So if you've got a grow up happening, there's just bad things happening, you're not taking care of the house. Again, big risk, and we have to kind of get you out of the house. Let's assume your PR status comes in early. So if it does come in early, we do have an early exit clause in our contract, which allows you to exercise earlier than at the end of 2 years or 3 years. You would be responsible for any cancellation fees incurred by the investor. So for example, if they have a 2-year or 3-year fixed mortgage and the bank is charging them fees to cancel, well then you would have to bear those costs. But we try and minimize the cost as much as possible so that you can take ownership of the house. Let's assume you cannot get your PR status within 2 years. Well, then we'll extend the deal by another year and we'll just adjust the price accordingly. We might increase the price by 3, 4, or 5%, and we just go for another year. So really, in terms of the risks, I would say that as long as you are a great tenant, you pay on time, take care of the house, and communicate well, things will go smooth and will work with you. And to date, every one of my tenant buyers has been like that, and I plan on keeping it that way. So why work with us? Well, our goal is to have 100% of deals reach successful conclusions. So we only work with tenant buyers that are very likely to succeed. We have resources to keep you on track. One of the things that I pay for is I pay for you to meet with a credit counselor. That credit counselor is going to put a plan for you together at the very beginning and then check in with you every 6 months to make sure you're on track, to make sure your credit score is going in the right direction. We have several happy clients. We certainly believe in transparency and fairness. We've got lots of good process to make sure everything is moving smoothly. And I've got a power team so that understands rent to own really well and can help you if you ever sort of need some assistance with anything. So if you're ready to get started with your journey to home ownership, there's a few things you can do. Number one, check out our website at renttogrowhomes.com. Click on Get Started, and there's a very easy application form there that will come to me. I'll get back to you very quickly to let you know if you're a good fit for the program, and we can talk. So that's it for this presentation. If you liked it, please let me know, and please feel free to reach out if you have any questions about rent to own or the NRST. Thank you.